The bond markets in India remind me of the story of the Frog Prince, where the princess actually kissed the frog and the spell was broken. Now, why I'm relating that fairy tale to the bond markets is because the borrowing program for the first half of 2019, that is FY 2019, was announced, where two things were pertinent. One, a cut in the borrowing program overall. Second is less than 50% of the total borrowing program will be done in the first half of the financial year. Not only that, it's been a fairly spaced out borrowing calendar where maturities ranging from 1 to 5 years all the way up to 20-year plus has been announced, including floating rate bonds which will be linked to the consumer price index or the CPI. Now clearly the markets which were struggling for lack of demand levers have found a new lease of life with the spell being broken, and that is the reason the bond yields rallied from highs of almost 7.6 to 7.65 levels to all the way down up to 7.3% levels on the benchmark 10-year bond index. As we speak right now, yields are at about 7.4% on the 10-year benchmark. Going forward, I think markets will focus on a couple of things. Now, with the supply being out of the way, largely being a non-dampener event, I think key would be the inflation data which will be announced in the middle of April, and of course the most important event, that is the monetary policy review on April 5th. I think the stance of the Reserve Bank of India, how they will view this government borrowing announcement, and more specifically the global events, how would RBI acknowledge it, specifically the recent rise in crude oil prices. On the liquidity front, the market will face a little bit of tightness because of the advance tax just being out of the way. But we believe that going forward with government spending, this money will actually start getting released into the system, which means an imminent cooling off at the shorter end of the yield curve seems quite possible. On balance, we believe that the markets have sort of created an upper lid on the yields with this announcement, and we believe a range-driven 10-year bond yield movement could be the port of call in the next few months. For investors in the fixed income market, we continue to believe that though there is an upper lid on yields, incremental news could obviously make the longer end a little bit volatile. So for those seeking a stable ride, could do well with a core allocation to accrual or corporate bond based strategies, and of course short-term strategies. Tail end allocations which have been done to long duration funds could continue to remain invested. On that note, a happy FY 2019 and happy investing. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.